Something historic is about to happen, and almost no one in the West is paying attention. Within the next 12 months, India is on track to overtake both Japan and Germany, becoming the third largest economy in the world.
Let that sink in.
For decades, the global order has revolved around a familiar axis: Europe's industrial powerhouses, Japan's technological rise, and later the economic dominance of the United States, followed by China's explosive growth.
That structure shaped the world you grew up in.
It shaped global trade, supply chains, political alliances, and even the price of the products sitting in your home right now. But quietly, without dramatic headlines or sudden collapse, that structure is shifting.
This isn't just a story about India rising. If you live in Europe or the United States, this is about you. It's about where jobs move. It's about how supply chains reorganize. It's about which currencies gain influence and which ones slowly lose leverage.
It's about the future cost of living in Western economies that are already under pressure.
The real question isn't whether India is getting bigger. That part is already happening. The real question is this: what happens to the West when it's no longer at the center of gravity?
For decades after World War II, Germany and Japan stood as pillars of industrial power. Germany became synonymous with precision engineering, machines, automobiles, chemical production. Japan mastered high-efficiency manufacturing and technology exports, building global brands that defined entire industries.
They weren't just large economies.
They were models. But now, a country long labeled developing is preparing to surpass them both. According to the latest IMF projections, India's nominal GDP is expected to reach approximately $4.19 trillion in fiscal year 2026, enough to overtake Japan, and closing in rapidly on Germany, whose economy sits around $4.7 trillion. The growth gap tells the real story. India's economy is expanding at nearly 10% nominal growth per year. Germany, by comparison, is growing closer to 2 to 2.5%. Japan is barely growing at all, constrained by an aging population and sluggish productivity.
At that pace, what once looked like an unbridgeable gap has narrowed dramatically. In 2014, India's GDP was roughly $2 trillion, less than half of Germany's. In just one decade, India doubled its economic size.
Germany, over the same period, added only about $500 billion. Historically, this is significant. Since the post-World War II economic order took shape, the top three global economies were always dominated by established industrial powers: the United States, Japan, and Germany.
That hierarchy felt permanent, predictable, structural. India is different.
Its economy is driven largely by domestic consumption and services rather than export-heavy industrial manufacturing.
It doesn't fit the old industrial blueprint.
And yet, it is about to enter the world's top three economies in nominal terms.
This is not just a reshuffling of rankings.
It signals a deeper shift, a gradual movement of economic gravity away from Europe and Japan, and towards South Asia.
India's rise isn't just about moving faster. It's about momentum and who is losing it.
India's growth is driven by scale.
With more than 1.4 billion people, its domestic market fuels expansion through internal consumption rather than exports.
Services form the backbone, with exports surging in recent years, supported by strong software revenues and the world's largest remittance inflows.
Digitalization has accelerated this shift.
Mass digital payments and tax reforms have expanded the formal economy, increasing government revenue and enabling a sharp rise in infrastructure spending. Roads, railways, ports, and airports are being built at scale, lowering logistics costs and crowding in private investment.
Demographics may be the decisive edge.
India's median age is around 28, and its workforce continues to grow, creating what economists call a demographic dividend. Now compare that to Germany and Japan.
Germany's median age is about 47. Japan's population is older still and shrinking.
Aging societies mean slower labor growth, weaker consumption, and rising fiscal pressure. Both countries also rely heavily on export-driven manufacturing models now under strain from higher energy costs and rapid technological disruption. Productivity growth has slowed, private investment has weakened, and trade surpluses have narrowed. In simple terms, India is powered by domestic demand, services, digital reform, infrastructure expansion, and youthful demographics. Germany and Japan face aging populations, structural rigidity, and industrial models struggling to adapt. One economy is structurally accelerating. The others are structurally constrained. India's rapid expansion raises a harder question. Does size automatically translate into strength? Or is this simply growth on paper? On the surface, the numbers are impressive. GDP climbs year after year. The country moves up the global rankings. But underneath the headline figures, the picture is more complicated. India's labor elasticity remains relatively low. Output is rising, yet urban youth unemployment remains in the double digits. Economists describe this pattern as jobless growth. Production expands without absorbing labor at the same pace. An economy can grow larger without necessarily becoming more inclusive. Then there's the structure of production. Manufacturing has hovered around 16 to 17% of GDP for nearly 2 decades, well below the level typically associated with sustained, labor-intensive industrialization. Instead, growth leans heavily on services. That brings speed and flexibility, but also vulnerability. Services are more sensitive to global cycles, and they tend to create a dual economy, a modern, high-productivity sector alongside a vast workforce that remains low-skilled and informal. Human capital adds another constraint. Public spending on education and healthcare remains significantly below advanced economy averages. That limits how quickly workforce quality can catch up with the pace of economic expansion. External pressures are also real. Currency depreciation can erode nominal gains when measured in dollars. Persistent trade deficits leave the economy exposed to energy price shocks. These dynamics raise a classic development risk, the middle-income trap. An economy becomes large but struggles to climb into higher value-added production. Now compare that with Germany. Germany's economy may be smaller in total size, but productivity per worker is substantially higher. Its industrial base is deeply rooted in precision manufacturing, machinery, chemicals, automotive systems supported by dense domestic supply chains. Above all, institutional stability plays a central role. Legal certainty, contract enforcement, and predictable regulation reduce transaction costs and investment risk. The result is not rapid expansion, but structural resilience. So the real distinction emerges. India is becoming larger. Germany remains structurally stronger per capita. Size changes rankings. Strength determines durability. If India succeeds in converting sheer scale into structural strength, the global order will not simply adjust, it will rebalance. For decades, the world economy has revolved around 2 dominant poles, the United States and China. A third gravitational center would fundamentally alter that dynamic. Supply chains would diversify further as corporations look beyond China for both production capacity and consumer markets. India would not just be an alternative factory floor, it would be a demand engine. Global labor flows would begin orienting toward new ecosystems built around services, light manufacturing, and digital infrastructure rooted in South Asia. Geopolitically, the implications are significant. A large democracy combined with a large economy creates a different strategic equation. It offers scale without an authoritarian governance model. For investors and governments alike, that changes risk calculations. It introduces a balancing force in a system increasingly defined by rivalry between Washington and Beijing. But the opposite scenario is equally consequential. If India fails, if growth continues without sufficient job creation, if productivity stagnates, if institutions fail to keep pace, the outcome looks very different. A vast economy marked by high inequality could face mounting social pressure, currency volatility, and recurring external shocks. In that case, global supply chains remain cautious. The world slips back into a de facto US-China duopoly, without a stable third axis.
For Europe and Japan, the stakes are immediate.
If India's rise solidifies, capital and technology flows will shift.
Manufacturing and service sector investment that might once have expanded within Japan or across European industrial corridors may increasingly redirect toward India. Multinational firms and financial institutions will redraw their risk maps.
Global growth would be driven less by aging societies such as Germany and Japan and more by young, consumption-heavy markets.
At a systemic level, the development model itself evolves.
The classic export-led industrial blueprint that defined post-war success gives way to a hybrid, domestic consumption, digital services, infrastructure expansion, and institutional credibility as the new pillars of competitiveness. In short, India's trajectory does not only determine its own future.
It may determine whether the 21st century remains bipolar or becomes structurally multipolar.